Hi everyone, welcome back to my YouTube channel. So this is Tashrita Gupta, your ACCA mentor, and this particular long lecture is for all the IFRS enthusiasts. So if you're giving any exam that is from any other qualification, precisely if you're doing it for diploma in IFRS, then this particular video is very essential for you. So just for my introduction, I am an ACCA mentor. I'm teaching the subjects of FR and SBR in ACCA. Plus, I'm also teaching diploma in IFRS. So if you're planning on to give your exam in the coming attempt, then make sure you do WhatsApp me on the details provided below to get yourself enrolled into my short yet very smart online course for diploma in IFRS. So this video can be used for the people who are preparing for their interviews, who just want to brush up on IFRSs, the ones who are giving their diploma in IFRS, anyone who is using IFRSs in their subjects of their respective qualification. So mostly my students of diploma are from CA background or are from ACCA background. So in ACCA also our IFRSs are widely tested in FR and SBR, right? And similarly in CA Inter, Indian CA Inter and CA Final, you do have your accounting knowledge enhanced in various subjects. So there are many overlaps. I would say if you are from ACCA background and you're preparing for diploma in IFRS, then the whole diploma in IFRS is kind of similar to SBR. It's somewhere middle in the middle of FR and SBR, right? So in SBR, your way of being tested was very extensive in form of case studies, whereas in diploma the syllabus is kind of similar, but the way of testing is little uh, easy. But from FR, it is next level. So I'll tell you that this syllabus area you've done till FR, and this is the syllabus area which is in addition to your diploma in IFRS subject. So let's, without any further delay, get into the video and make sure you take the utmost benefit of this lecture and do share it with the people who are also preparing for their IFRSs in whatever field they're preparing for. So let's get started, guys. Okay, cool. So as I said, my introduction, ACCA mentor, FR, SBR, and diploma in IFRS. So if you want to get enrolled into diploma in IFRS, you need to contact me at this number. And this is my FR and SBR ACCA course. So if you are from ACCA background, preparing for FR or SBR, you can find my premium courses, full recorded lectures with WhatsApp tutor support and mocks and assignments being assessed for your December attempt at wifi.com. Okay, now guys, let's begin with our various IFRSs which are in question for the day. So there are many IFRSs that I want to cover in one single video. So it will be a fast track revision, okay? It won't be something that I'm doing from the scratch. It will be a fast track revision. So the first things first, let's consider what is the source of our IFRSs? From where is the source coming? IFRS is international financial reporting standards, right? They are the global accounting language. I call them as global accounting language. Why? Because they are something which is multinational, okay? And multinational MNCs. If you're preparing for your interview in one of the MNCs, they are going to use these IFRSs. So they are involved in global accounting. They're not just located in India, or they're just not located in one single country, but they are present worldwide. So they have global accounting requirements. And that's where the global accounting language IFRSs come into picture. So every language do have certain principles, no, it do have some source from where the knowledge is coming. That source in IFRS is our conceptual framework. Conceptual framework, guys. It's the bedrock of IFRSs. That's how your IFRSs are actually prepared. Based upon the conceptual framework, we are told what kind of financial statements do we need. Okay, let me just organize this for you. You have a multinational company and that is operating globally, worldwide, and you need to prepare their financials. That's what an accountant does. So, as an accountant, you want a global language. So, you went for IFRSs. And now those IFRSs will be based on certain objective. What is objective of any language? That everyone understands it in that area and it is quite easy, crisp and concise, right? And it makes sense. So similarly, IFRS is a language which is based upon certain principles, which says that if you are preparing your financial statements, that's a format through which you utter that financial information to the stakeholders, right? Stakeholders are the people who are interested in your company. So the financial statements that you prepare, the conceptual framework tells you that this financial statement should be what kind of qualities this financial statement should have. That is given to you in conceptual framework. What kind of qualities? First quality they say is primary quality, that it should be relevant. Second quality says that it should have faithful representation. Now, relevance means whatever I am preparing should be material. I should not omit anything that is material. Material means something which affects the decision, economic decision of the users, right? So whatever I am preparing should be relevant, should be material, and it should be faithfully represented. Faithful representation in accounting means, number one, you have economic substance over legal form. Economic substance over legal form. What does that mean, ma'am? Okay, let me take an example. If you have covered your syllabus partway through, you know about sale and lease back. In sale and lease back, legally it is a sale and we are renting it back. But still, economically, what do we want to do? We want to refer to IFRS 15 to ascertain whether there is a sale or not. That's what you do. So to ascertain whether there's a sale or not, why are you referring to IFRS 15, whereas legally it is a sale? Because in accounting, you follow economic substance over legal form. You don't take it on the basis of legality. Legally, it might be a sale. Legally, it might not be a sale. Still, you might consider it as a sale because economic substance reflects so. So economic substance means what is the importance of that transaction in your accounting standards. So this is our first thing in faithful representation. Secondly, what is the second thing in your faithful representation? That your financial statements are complete, neutral, and free from error. So this is what is there in conceptual framework, relevance, and faithful representation. Now, based upon these two qualities, the whole accounting language is framed. Now, whatever you are preparing for the IFRS, whether it's an interview, diploma, exam, or whatever, you should know this thing because that's what the source is, guys. That's why you're preparing the financial statements. That's what your ultimate objective is. Now, based upon this objective, you have multiple standards formed. Just like I always give this example. So just like our school used to say that the gates of the school will close at 8 a.m. What was the objective behind it? To install discipline in everyone, right? So that discipline was the objective, and to meet that objective, various laws were framed. Break time will be this, gates will close at 8 a.m. You have to be strictly in the uniform, you have some attendance requirements. So there are certain rules framed upon the source. Now the source here is relevance and faithful representation, because of which there are certain rules. And you know what the irony is? If sometime there is a conflict between the rules that you've made and the objective that is there in conceptual framework, the rules win. That's the irony, because that's what usually happens. If we say that we should not cross the red light, we should not cross the red light. So that's a rule. If you cross that red light, maybe because you have a medical emergency, still you breach the rule and you will be punished for that. So that means the rules, after certain point in time, the rules take advantage over the objective. So conceptual framework, more or less, just remains as a bedrock of IFRS, just like a moral science lecture. And the actual rule, the actual standard is your IFRS. So anytime there's a conflict, between the conceptual framework and the IFRS, then your IFRS is going to win, right? So that's what is there in your conceptual framework, which is the source for IFRSs. Now let's start with our certain very basic standards. First basic standard is made up of our non-current assets. So I will start with non-current assets first. That's something that you've done at your FR level, as well as like in our BComs also we've done these things, non-current assets, where we basically talk about any asset which is kept for more than 1 year. For more than 1 year, if you keep any asset, that is your non-current asset, right? Now the point is, this asset can either be a tangible asset or it can be an intangible asset. We all agree on this? So there are various standards made up on non-current asset. Let's see what are those standards. Standard number 1, that is basically on your property, plant and equipment. So let's understand that. Property, plant and equipment. So if I have any property, plant and equipment which is used in manufacturing or which is used in manufacturing or which is used in administration, or which is owner occupied, not used for manufacturing or administration, but the owners live there, or it is given out on rent. Now that is classified as PPE IS 16, right? Everyone knows this IS 16 basic standard of your IFRSs. Now guys, this particular owner occupied or manufacturing or administration use property, plant and equipment has some initial measurement. What is initial measurement? See, as accountants, we should know the day this asset arises in our books of account, at what amount should you record it at? At what amount should you record it at? I use the word asset. Now that definition of asset is also coming from conceptual framework, where they say that asset is any economic resource. It's any inflow of economic resource which is due to past event, and that is something that you control. So something that you control, which is an economic resource because of a past event, is your asset. Previously, we used to have the concept of probability here. Now that probability concept has been waived off, completely waived off. Prior to our conceptual framework 2013, it used to have the concept of probability, which is not there now. Still, some standards still talk about probability. So my initial measurement of IS 16 is at cost. And the components of this cost is purchase price plus directly attributable cost plus any dismantling cost which is taken to its present value plus any borrowing cost plus any irrecoverable tax. Now, what do I mean by all these things that I've written? So my directly attributable cost is anything which is related to obtaining any cost which is related to obtaining the asset, installing the asset or bringing it to ready for use situation is a directly attributable cost. For example, if you buy a washing machine, the cost that you bear to install the washing machine, the cost that you bear for the carriage inwards, that is basically your directly attributable cost. And in this, always remember that your training cost is not capitalized. Why? Because I told you the definition of the asset under conceptual framework. Asset is something that you control. So can you control the training cost? Those of you who are watching this video, can I control how you are understanding this video and how you're going to execute the skills that you get from this video? Or will you use this skill that you get just for my firm? Right? So I can't control that. Employees can leave anytime they want to. Employees can die. So that means the transaction cost can never be capitalized. Then dismantling cost at its present value, because this is unavoidable, right? Just the day I buy the asset, I know that this cost is unavoidable. I will have to incur this. So what I do, I add it into the cost of the asset, that too at present value. And this present value, wherever you will calculate, I'm telling this for once and all, wherever we are going to calculate the present value, we are going to unwind the interest. So this dismantling cost is something on which you also create a provision under IS 37. So this is a fast track revision. I am sure you know what is a provision. Provision is basically the present obligation for something which you're sure of, you're probable that you're going to end up paying this amount. So that's your provision. So for this dismantling cost, you also create a provision, and this provision is created at present value. And since you calculate this at present value, the unwinding of interest will happen on this provision subsequently, where you're going to pass a journal entry, finance cost debit and my provision credit. So that's my initial measurement. Borrowing cost, we have a proper standard IS 23 on it. Irrecoverable tax. So if I pay tax, I recently bought some equipments on which I paid GST. So if I was GST registered, if I am GST registered or my firm is GST registered, I can claim the input of it. That means I can actually go to the government and say, I paid this much GST and this is what I collected. You just net them off, whatever is the balance. Either I will have a liability to pay you the tax or you will give me a refund. So you claim that input. But if you're not GST registered, then you don't get that benefit. You don't get that benefit of netting it off. So it becomes irrecoverable tax, which needs to be added to the cost of the asset. So this is what is given to us in the initial measurement of IS 16. Now, guys, what is the subsequent measurement? Initial measurement of IS 16, IS 38 on intangible asset and IS 40 is exactly the same. Same, cut to cut. Now, subsequent treatment of all of these three, I will tell you together. We'll prepare a table together. For that, I need you to understand what is your intangible asset. What is your intangible asset? So, intangible asset is recognized because whenever we call something asset as intangible asset, when it has no physical substance, okay, there is no physical substance, number one. Then secondly, it is identifiable. It is identifiable. What do you mean by identifiable? That is something which is separable or is arising out of a legal or a contractual right. Legal or contractual right. That is what I mean by separable, identifiable. So for example, guys, if you have some kind of license, I have a driving license. Can I sell that to you? No, that's not allowed. If I have a license issued on my name, that's my license. I can work on that. But it is rising out of a legal or a contractual right. So I can recognize this as my intangible asset. If you have brand, goodwill, externally generated goodwill, purchased goodwill, you can sell it separately. So that's why it is separable, because it can be sold separately. Similarly, if you develop a software, can you sell that developed software? Yes. So it is identifiable. Thirdly, you have a probable inflow of economic benefits. Probable inflow of economic benefits. Can you see the conflict here? I told you the conceptual framework doesn't talk about probability in the definition of an asset, but still intangible asset is talking about this probability concept. So can you see the conflict? And wherever there is a conflict, IFRS will win. So yes, IS 38 is in conflict with conceptual framework, still IS 38 is going to win. So probable inflow. And lastly, you can make a reliable measure of it. Now, since guys, reliable measure is not possible for many items or many elements in our financial statements, that's why we do not record internally generated brands. Internally generated brands, they have no physical substance. They are kind of identifiable. They will lead to inflow of economic resources. Still, we don't record them as intangible asset in individual accounts because there is no reliable measure available. So that's what you mean by IS 38. Now, what is there in IS 40 investment property? Basically, any property that you hold for capital appreciation, okay? Any property that you hold for capital appreciation, or any property that you hold for giving out on rent to others. We all have such properties in our family. They are just lying idle. Nobody is living in that. We've either given it on rent, or we are planning to give it on rent, or it's just idle. And our parents would boast about it. We bought it at this amount, and now this has increased to this amount. So they are happy about that capital appreciation which has taken place, right? So that's our investment property. And if you hold that property merely to give it out on rent to others, then once again that becomes your investment property. Now the question is that in IS 16 also I wrote this definition, that owner occupied and given on rent. And in IS 40 also I've written this rent rate. So if a property is given on rent, whether should I classify it under IS 16 or should I classify it under investment property? That's the question. So reply to me in the comment section. What do you feel? Pause the video and let me know what do you feel about this. Okay, so let me tell you, I hope you have brainstormed and you just don't depend on the tutor telling you everything. You should try yourself also. So rental property, guys, if first of all, we are living on the ground floor and we have rented other floors of our property and we can't bifurcate. The fair value of the ground floor and first floor cannot be determined separately. They are not separable. In that case, since it is owner occupied, it is IS 16. Second fact is that if you give your property on rent for shorter durations, that means that's your work. That's what you do. You give on rent and you've only kept that property for rental income. So that becomes investment property. But if you have taken a property on rent for a longer term, that means it's a finance lease and you are a lessee. You are a lessee and you have taken a property on rent for a longer duration. So what happens? What does the lessor do? In the IFRS 16, if it's a finance lease, lessor derecognizes the asset. In the lessee, we don't have that bifurcation between operating and financial. But in the lessor accounting, if there is a financial lease, the lessor will derecognize the asset, right? Because he thinks he has sold the asset. So if you have taken that property on rent, if I have taken a property on rent for 10 years and the life of the asset is 9 years, so that's my property, plant and equipment because I'm using that in my business. So don't go into that much detail, but yeah, that's what the bifurcation is. So mostly if you see the word rent and there's no owner occupation, there's no owner who lives in that property, then you will consider it as investment property. If it is idle, you will consider it as investment property, otherwise PP. Okay. Now let's understand the subsequent treatment, everyone. Let's understand the subsequent treatment of all the three types of standards that we have just done. So first of all, what we have is IS 16, then you have IS 38, then you have IS 40. So subsequent treatment under IS 16 and 38 is once again same. Cost model and revaluation model. Whereas in IS 40, it is cost model and a fair value model. Now guys, when the name of the standard is same, the content is same, the rules are same. So here there is cost model and cost model. So the rules are same, that I'm going to keep my asset at carrying amount. What happens in revaluation model? I take the asset to its fair value, but I don't take it at, you can say, each reporting date. I will take it to its fair value whenever I feel that the difference between the fair value and the cost is really high now. So let's take it, do the revaluation. So it's not at each reporting date, whenever you feel it is significant. Then when you revalue your asset, you should revalue the whole class of assets. Okay. You cannot just revalue one property and be done with it. You have to revalue the whole class of assets. And whenever there is a revaluation and the revaluation gain arises, it is a revaluation upward. Then the gain goes through OCI. And if it is a revaluation downwards, first you take out the loss via any revaluation surplus which existed in the past related to that particular asset and the remaining from the P&L. So this is the rules. These are the rules under revaluation, and you do depreciate the asset which is revalued. You depreciate it at the revalued amount divided by the remaining life of the asset. So that's the rule under revaluation model. What is the difference between this revaluation model and a fair value model? In the fair value model now, they say, first of all, investment property is taken to its fair value at each reporting date, okay? And it is not depreciated. Now, ma'am, why is it not depreciated? Because it's already taken to its fair value. We all understand this. It's already taken to its fair value. And that fair value gain or loss will also go through statement of profit and loss. So my investment property is already taken to fair value with the gain or loss being reported in the P&L. So they say there's no need of any depreciation now. There's no need of any depreciation now. If you think otherwise, that anyway you're not using that investment property and you're taking it to its fair value, if the value would have reduced, it would be reflected in the fair value change. So there's no need to depreciate your investment property. Cost model, everyone knows we have to keep it at carrying amount, cost minus accumulated depreciation minus impairment, that is our carrying amount. So that's a brief revision of our IS 16 and IS 40 and IS 38 subsequent treatment. Now in IS 38, we also have one more thing, that is the difference between research and development. Intangible assets, research and development. For this, we apply the Pareto. Pareto is probable, okay. Pareto is P-I-R-A-T-E. If this Pareto is met, we say the costs are related to development, which must be capitalized. If the Pareto is not met, then we say that the costs need to be immediately expensed in P&L. So Pareto P stands for probable economic benefit. So whatever thing I am developing will lead to economic benefits, and that's probable. I stands for intention. I have an intention to complete the development, right? R stands for I have resources to complete that development. A stands for that I have the ability. Once the development is done, I have the ability to either use the developed product or to sell it. T stands for technical feasibility. I have that technique, that software, hardware through which I can actually develop or I can use that developed thing. So there's technical feasibility and there's a reliable estimate available. Now this is what we do for our research and development. Now guys, we are done with non-current assets basics. This is something that we have done in FR also, right? And it's basic to diploma also. Now we have some other standards, but I will just take the important ones, okay? Because it's a revision series, it's not a lecture. So we will take the important ones. So let's talk about IS 36 impairment now. Impairment says that in that we take into consideration what is impairment? Reduction in value of the asset. Reduction in value of asset. Now, how would I know there's a reduction in value of any asset I have? I look for indicators. Now, these indicators might be external indicators or these indicators might be internal indicators. Now, will this indicator come to you dancing that I'm an indicator of impairment? No. You have to, at each reporting date, look for indicators. So if you give your AAA exam in ACCA, there we have procedures related to how do you look for indicators, isn't it? So external indicator or internal indicator. In this external indicator, we talk about something which is not in our control, not in control. In internal indicators, we talk about something which is in our control and indicates impairment. For example, performance of any PPE. Any asset which was generating 50 units per minute suddenly has started producing 20 units per minute. So that's an indicator of impairment. Now, whenever there's an indicator of impairment, you need to conduct impairment review where you compare the carrying amount of the asset with the recoverable amount of the asset. And in this carrying amount, you know what it is: cost minus depreciation minus impairment. Recoverable amount is higher of two. One is value in use and another is fair value less cost to sell. Now, this value in use is present value of future cash payments. So if I keep on using the asset, how much money that asset will generate for me, that's a value in use. So that asset, if I use for 10 years, the money inflows, I will estimate and I will discount them to the present value. That would be my value in use. But if I sell that asset today, how much money will I realize? That is fair value less cost to sell. So higher of these two figures is my recoverable amount. When I'm conducting impairment, I have to make sure that my carrying amount, I take the lower of carrying amount and recoverable amount. So in a situation where currently your carrying amount is greater than the recoverable amount, you need to reduce this carrying amount to recoverable amount. That will induce or that will start the process of impairment. That will actually create impairment when I'm going to reduce the carrying amount to its recoverable amount. And that impairment is always taken through statement of profit and loss. So my impairment loss goes through P&L unless I have a revaluation surplus already, just like revaluation downwards. If you already have some surplus related to this asset, you can take it via revaluation surplus. So that's the basic of impairment. I'm just giving you the basics, okay? I'm just brushing up your standard. Not there are many other details also in impairment. Then one more important concept from impairment is cash generating unit, CGU. So it's a smallest group of identifiable asset, smallest group of identifiable asset which can generate individual, or you can say independent cash flows. Example, if you are an owner of a resort, let's suppose JW Marriott. Now, JW Marriott is a big resort chain around world, I suppose. And let's suppose they have some kind of cafeteria there. Now that cafeteria is generating its independent cash flows. It's not dependent upon the room service. It's not dependent upon the spa area. It's not dependent upon your any other services this resort is offering, maybe banquet halls. So the point is that this cafeteria in itself is an independent cash flow generator. So I consider it as a CGU. So if I'm conducting an impairment of the CGU, you just need to remember point number one, that first you allocate the impairment to damaged asset, then you allocate the impairment to goodwill. So why would you say that customers in JW Marriott cafeteria have reduced? Because the goodwill of JW Marriott is impaired. So first to the damaged asset, we are going to allocate the impairment, then to the goodwill. Then I'm going to allocate it to other non-current assets at pro rata basis. Okay. That means I am going to weigh. For example, the remaining two assets are PPE and other intangible assets. So you have 15 million for PPE, 9 million for other intangible assets, and unallocated impairment balance is 4. So you will say how much will be allocated to PP? 15 divided by 15 plus 9 into 4. And how much is allocated to other intangible asset? 9 divided by 15 plus 9 into 4. Right? So this is what I mean by pro rata basis. Do I impair current assets? Answer is big no, no. Why? Because current assets are already at their lower of carrying amount and recoverable amount. I need not impair them further. So this is something that all should remember from impairment. Then you have IFRS 5, non-current asset held for sale. So here basically you just see caption, whether caption is met or not. There are many nitty-gritties involved in the standard, but the basic is caption. Commitment to sell. Is the management committed to sell the asset? Is there an active plan to sell the asset? How do you know there's an active plan? If you are looking for buyers, you have listed your asset maybe on OLX or somewhere on Amazon. There is a sale which is in the present condition. That means you're not using that asset any forward and you're going to sell it without any repairs or overhaul. And the sale is probable, sale will happen within 1 year, and there will be no change to plan. So this is what you do in IFRS 5. And the accounting treatment under IFRS 5 is simply you will call the non-current asset as current asset now because you're going to sell it within 1 year. And you are going to keep that asset at lower of cost and NRV, that is your recoverable amount. You will take that loss through P&L and you will stop depreciation. Why? Because you're going to sell it in the present condition. That means you're not using the asset. If you're not using the asset, you did not depreciate. So that's it about non-current assets full-fledgedly. There are some other standards like government grants, borrowing cost, all those things, agriculture. I'm not covering those. Okay, this is a fast track revision. So I'm just considering the basics of the standards. It's just like I am assuming you guys have done something already and then you are attending this lecture because it is for revision purposes. Then let's consider another aspect of our IFRS, that is our IFRS 15 revenue. Now in IFRS 15 revenue, what we have is revenue from contracts with customers. So it's a 5-step approach. What do you do in this 5-step approach? Number 1, you identify if there is a contract or not. You identify the contract. Once you've identified the contract, what is a contract? It's a 2-party agreement. Both the parties have identified their rights and obligations. They have decided how they're going to make the payment, and it is for commercial substance, and it's probable that you're going to receive the payment. Because you can't say a charity is a commercial contract. Contract, something that you need to record in your financial statements, must be arising out of commercial reasons. And it should be made sure that you are going to receive the benefit. So we are going to record the contract. Second, we are going to see how many performance obligations exist. How many performance obligation exist in that particular contract. So what is a performance obligation? The promises made by the entity to the customer that they are going to serve under this contract. So there might be 2 services under one contract, 3 services under one contract. So you need to identify how many services are there. So we call them as separate performance obligation or single performance obligation. So if delivery of one performance obligation is dependent upon the delivery of second, then they're not distinct. And if they're not distinct, they can't be considered as separate performance obligations, right? So they're single performance obligation. Example, if you are laying foundation of a building, you're a construction company and a customer has given you a contract, please lay the foundation of my building. You're laying the foundation, you're doing the construction, the whole structure, you are making the walls, and then the customer says, please also paint the walls. So is it a separate performance obligation? Answer is no. Can you paint the walls unless the walls are being constructed? No, right? So if you can't do that, so you will have to clearly say that this is a single performance obligation because delivery of one obligation is dependent upon the delivery of second, right? Then third is determine the transaction price. Now, what is your contract price? You need to determine that transaction price. So here you're simply going to say there are various factors involved in the transaction price. Point number 1, what do we talk about here is within the transaction price, we talk about, let's suppose you entered into a contract and the contract price was $200, but there was something variable involved in that consideration. So what about variable consideration in revenue? They say if there is a variable component, you have to take the most likely outcome. Okay, what is most likely? Are you going to receive this money or not? If yes, record it in the transaction price. If not, don't record it. So they give a very stupid line in the standard which says record the variable consideration up to the extent it is highly probable that there will be no significant reversal once the uncertainty is resolved. So just basically this means that you have to record the transaction price if you think that this is not going to lead to a reversal in future. So if the question says that you are receiving $50 extra if you do not commit any mistakes in your construction. So $50 is too less. So let's suppose you're doing something, you're doing some performance obligation, and if you do not commit any mistake, you will get this extra $50. So you will ascertain the probability of it based upon past trend. How many mistakes have you committed till now? How many do you expect more? What have been your track record? Based on that, you will calculate the probability and record this 50 at expected value. So you'll multiply this 50 with the probability of not making mistakes, and that will be your expected value at which you are going to add this to your transaction price. Then they say there is a significant financing component. Wherever there is a financing component, that means you're going to receive the payment more than 12 months later. So that basically means financing component leads to present value and the sibling of present value. Whenever you order something, your sibling comes in dancing, they also want to share in that. Similarly, whenever you calculate present value, one thing comes in dancing, which is known as unwinding of interest. So if there's a financing component in your transaction price, first of all, calculate present value and make sure you unwind the interest. Then, third is non-cash consideration. Non-cash consideration. So here, what do we consider? If I'm selling my lectures and in return you say, ma'am, I will edit your videos. So I am taking your editing services or you are taking my teaching services. It's a barter. Now here, if I have to record my revenue for the teaching services that I'm providing, I will ask you, what is your editing fees? What is the fair value of your editing fees? And that would be my revenue because that's what I'm receiving, right? By teaching you, I'm receiving editing services. So what is the editing services fair value? I will record that as my revenue. But if you say, ma'am, I'm doing this for the first time, I don't know. So I will then consider what is the fair value of my lectures and that will be treated as my revenue. Then lastly, we have any consideration payable, cash paid to customer. Cash paid to customer. Now, what is this? If you pay cash to the customer, you might pay some cash to the customer because he's also a business. So let's suppose you are a construction company, but you're also studying for ACCA. So I used your services to construct my house. So I have to pay you money and you are studying ACCA or your sibling is studying ACCA from me. So you're paying his fees. So it's just like we can net it off. We won't do that stupid thing that I will pay you 5,000 and you will pay me 5,000. No. So we'll just net it off, right? So that's what we do in cash paid to customer. Now, what if you're paying cash to the customer to give him some relief? Maybe to comfort him. Why would you comfort any customer by paying cash? Let's suppose the customer says, to get your services, I have to travel this much, 100 kilometers. So I am not okay with visiting your store. So you're like, okay, we will bear the cost of you coming here. Maybe you're a jewelry store. And you say, we will bear the cost of you coming here. You come here, buy the jewelry. And that will be like a huge thing when you buy the jewelry. So for you as a jewelry shop owner, it's okay if you bear his travel cost. So you give that cash to the customer. Now that acts as a subtraction, that acts as a minus from transaction price. Okay. So this is what is there in our step number 3, determination of transaction price. Step number 4 is allocate the transaction price to the performance obligation. Allocate transaction price to performance obligation. Now they say that this allocation must happen on standalone selling prices. So if a contract is for 500 and I'm providing two services within it and the fair value of those two services is 300 and 300. So total is 600, but I'm charging just 500. Maybe it's a bundling discount. So I need to allocate it based upon pro rata. So how do you do the pro rata? Comment down. I will reply you back. If the two services are 300 and 300, I've discussed pro rata in IFRS, this IS 36 already. CGU, allocation of impairment. Total is 600 and I need to allocate it because the contract price is 500. This is performance obligation A and B. Calculate in the comment box and tell me what will be the allocation. Homework. Okay. Step number 5. Recognition of revenue. Recognize the revenue. How do you recognize the revenue? You can recognize the revenue over the period of time or at a point in time. At a point in time. Now, guys, when you recognize over the period of time, whenever it is not over the period of time, it is at a point of time. So, at a point of time doesn't have any sort of, you can say, identity in itself. So, if it is not OTP, it is at a point in time. So whenever it is not OTP, it is at a point in time. So when is it OTP? It is OTP when, point number 1, the customer is simultaneously receiving and consuming the benefit. Receiving and consuming the benefit. What does this mean? For example, all of you who's listening to this video, you guys are simultaneously receiving whatever I'm teaching and you're consuming it. Can I ask you, be Dumbledore, take out that nerve and give that whatever I taught you back to me? Is it possible? No. So that means whatever I've taught is delivered to you, you've received it, you've consumed it. So always as a tutor, we will recognize the revenue over the period of time. So if I'm teaching for 3 months, I'm going to recognize my revenue OTP. Then second is you are enhancing the asset controlled by the customer. Customer controls the asset and you're enhancing it. Example, you are a construction company and the customer's piece of land, you are constructing a building. Now, next day customer says, don't come. I'll keep some other contractor. So you're going to cry that I've done the work and this person is saying, don't come from tomorrow. So in that particular case, we simply say that we have a right to payment. We constructed the building on your land. So it's your duty to pay us based upon the progress. You can't be Bob the builder and whatever you've constructed, you will carry on your shoulders and run from there. Not possible. So you'll be crying in the corner, max to max. What you will do is you'll take a bulldozer and you'll run it over whatever you've constructed. Again, the loss is yours because they have not paid you anything, and they're saying don't come from tomorrow. And you can't take that land along with you because that belongs to the customer. So there you have a right to receive the payment based upon progress. That's why the revenue is recognized OTP. Then if you are enhancing the asset, which is controlled by you only, so entity is going to control the asset this time. So the land is also mine. I'm constructing a building. Then why OTP? Because that is a customized thing. That means I do not have any alternative use. I'll give you an example. Back in 2020, one of the students from Sri Lanka, I used to teach audit also. One of the students from Sri Lanka said, "Ma'am, please teach me audit of Sri Lanka." I was like, "I don't know the CA of Sri Lanka. How can I teach you audit of that country?" He said it's very similar to ACCA. So I was teaching that. He enjoyed the classes. So he said, I need those classes from you. So I said, okay, I was free back then. So I will record the lectures for you. But in that case, it's something that I'm doing based upon customization, right? Even though the lecture belongs to me, but I don't have a market in Sri Lanka where, if not you, to whom will I, deliver those lectures? So it was a customized thing. So we entered into a contract that I am going to shoot the lectures. I'm going to teach audit of Sri Lanka to him, but we made a contract where I had an enforceable right to payment based upon whatever progress. Mostly in these cases, we take an advance. But if you have not taken an advance of the full 100% thing, you make a contract that based upon the progress, we are going to receive the money or we are going to record the revenue. So when you are enhancing the asset which is controlled by you only, but it is customized and you have an enforceable right to payment, then in that case also you recognize the revenue over the period of time, right? So this is the 5-step approach that we have in IFRS 15. Now in IFRS 15, there are many other aspects, contract modification, which is there. You guys have done in SBR also. There is sale and repurchase, consignment, all these things. So basic thing to that is control. So you consider the definition of control from IFRS 15 only. When is the control passed? Control is passed whenever the risk and the rewards are transferred. Okay, so the party which has the risk and the rewards is the owner. So in agency theory also, if I am selling something on behalf of the principal, I will record agency commission fee as my revenue. And the person who has the risk and the reward will record the actual revenue. Right? So these are certain things which are there in IFRS 15, which we have just brushed up in like few minutes. So it's a fast track thing. So I will cover the basics only. Now, next, let's take into account next standard and the favorite standard for almost everyone, IFRS 9, financial instruments. So what is there in IFRS 9? They say there is a financial asset in IFRS 9 and there is a financial liability. Financial asset and a financial liability. What is a financial asset, financial liability? It's a contractual right to receive cash or any other financial asset. So you have a contractual right. You're going to receive it by contract. Financial liability is a contractual obligation that you're going to make a payment. So that's what IFRS 9 is based upon. So financial instruments is any transaction which gives rise to a financial asset in the books of one company and simultaneously a financial liability or equity in the books of other company. That's what a financial instrument is. Now they say there are two types of financial assets. One is debt instrument. Another is equity instrument. Debt instrument and equity instrument. So if you buy debentures or bonds of a company, we call that as debt instrument. If you buy shares of a company, we call that as equity instrument. Initially, on the date these things are recorded in the financial statements, initially, all our debt and equity instruments are recorded at fair value plus minus transaction cost. Why did I say plus minus? Because transaction cost is deducted from the fair value in case of liabilities. Star point. Why? Because capitalization is a happy process. So cost means you're paying cash. So cash is going to get credited. In case of asset, asset gets debited. If you debit an asset, the asset increases. If you debit a liability, liability decreases. Right? So initially, all my financial instruments are recorded at fair value plus minus transaction cost. Unless subsequent method is fair value through P&L. So subsequently, if that financial instrument is kept under fair value through P&L, then you do not capitalize the transaction cost, or else you do. Now, what are the subsequent treatments available under debt and equity instruments? First, let's talk about debt instruments. So in debt instruments, guys, we have three methods. One is amortized cost. Second is fair value through OCI. Last, we have fair value through P&L. So in this, how do we decide which method to choose? We have two tests. One is business model test. Another is contractual cash flow test, which I call a CCF test. So if you have met the CCF test, then only you move to business model. If you have not met the CCF test, then you go for fair value through P&L option, which basically means that each reporting date, my asset will be taken to fair value with the gain or loss being reported in P&L. Now, what in the world is this CCF test? So if you have given loan to someone, you say, I am going to get the receipt of principal and interest just in cash, just only in cash. There will be no in-kind consideration. So for example, there's a convertible debenture. In that convertible debenture, along with cash, you are also receiving some option, share option, to convert the debt into share. Now, in that particular case, what happens is you have something in kind. So CCF test is not met. So if you buy a convertible debenture, it is always recorded under fair value through P&L because the CCF test is not met. Now, if the CCF test is met, we are just going to receive the payment of principal and interest at cash, in cash. Then you move to business model, which talks about your intention. Now, here the intention means if your intention is long term, then you're going to keep it under amortized cost. If your intention is, I don't know, situationship, I don't know, I might keep this asset with me, I might sell this asset. So in that case, you're going to keep it under fair value through OCI. And if your intention is short term, casual, short term, then for sure you're going to keep it under fair value through P&L. So these are the factors, the two tests based on which I decide whether to choose for amortized cost, fair value through OCI, or fair value through P&L in case of debt instruments. I hope we are clear. Now guys, debt instruments are also subject to some impairment. Now this is not something that you've done at FR level or you're required to do at FR level. This is something which we do in SBR and which is also there in your diploma. So impairment is reduction in value of the financial asset. So you're going to impair your debt instrument. So for that, they say impairment, you should know some terms. Term number 1, credit risk. Now this credit risk is risk of non-repayment. Risk of non-repayment. What if people don't repay? I've given loan to someone. What if they don't repay? I will be screwed. So for that matter, what we do, if this is the person to whom I have given a loan, I will always keep a skeptical eye on this person. Isn't it? If you give loan to someone, try giving even slightest of the money to someone, to your friend. You'll always keep a skeptical eye whether this person is going to repay me or not. So you, based upon this skepticism, you develop some kind of expectation that this is what I expect this person is going to pay. Then you compare your expectation. This is a byproduct of your overthinking only. It's not something this person has communicated to you. He's enjoying his life. You are doubting this person and you've come up with an expectation. You are going to compare what you expect to receive from this person with what is given to you in the contract. So if you have given loan to someone, you must have signed a contract with someone. So what is there in the contract that he's going to repay 1 million each year, but I expect he will just repay 0.8 million. So there's a loss of 0.2 that is known as credit loss. So what is credit loss? Credit loss is difference between what you expect to receive versus what is there in the contract. Now, when you take this credit loss, to its present value and you probability weigh it, when you take it to its present value and you probability weigh it, that means you calculate expected value. Whatever you get is known as loss allowance, right? So this is what we mean by loss allowance, impairment of debt instrument. Now there can be two types of loss allowances. So let's understand what are the two types of loss allowances. They say either we have 12-month expected loss allowance or we have lifetime expected loss allowance. So this 12-month expected loss allowance is when the credit risk has not increased significantly. The credit risk has not increased significantly. If your risk has not increased significantly since inception, the day I gave loan to someone, what was the credit risk? Every time you give loan, there's a risk. What was the credit risk then? Maybe 10%. Now at the reporting date, that has increased to 80%. So significant increase. So from the case study, you will understand, they will use some terms and you'll get to know this is significant, this is non-significant. So then you are going to say, if the credit risk has not increased significantly, we will create a 12-month expected loss allowance. If it has increased significantly, I'm going to create lifetime expected loss allowance. And these loss allowances, guys, are always created via P&L. So journal entry is P&L debit loss allowance credit. Once again, this is something you've not done in your FR, but you do it in your SBR. But it is there in diploma. So if you see this is a new thing to you, so you know that you've not done this in FR. Right? So this is how you create your loss allowance. Now, guys, let's come to next point. What if there is a loss allowance in case of a debt instrument which is kept under fair value through OCI? They say this fair value movement is going through OCI. So if there was a debt instrument of 1000, which was brought down to a value of, let's assume 800. So there was a loss of 200. Now this loss of 200 has gone to other comprehensive income. Over and above this, they've given to you that create a loss allowance of 150. So you can't take your asset to lower than its fair value. So you can't deduct 150 from this 800. So you'll simply say, I'll bifurcate this 200. One part of it is 150, one part of it is 50. This 150 will be treated as my loss allowance under it will go through statement of profit and loss. And this 50 will be treated as my OCI fair value, right? So that's something for debt instrument. Then in IFRS 9, we also have equity instrument. In this equity instrument, what we have is, we have two methods. One is fair value through OCI and fair value through P&L. By default method for any share that you buy is fair value through P&L because mostly we hold it for trading only, right? But if these two conditions, both the two conditions are met, then we can choose for fair value through OCI. Condition number 1, must not be held for trading. Your equity instrument must not be held for trading. Condition number 2, you made an irrevocable choice. Irrevocable means unchangeable choice upon designation. Upon designation. So the day that instrument was born in my financial statements, when it was designated, on that day only I made a choice that this is fair value through OCI, right? So this is how I keep my equity instrument under fair value through OCI. Now guys, financial liability. Financial liability is very simple. You have two methods for it. In FR, you did only one method. That was amortized cost, right? Then in SBR and IFRS, now you have new method, that is fair value through P&L. So amortized cost is simple. Opening liability plus interest minus cash is equal to closing liability. And that interest is calculated at effective rate of interest, cash is calculated at coupon rate, and you get a closing liability. When do you opt for fair value through P&L? That's the question. We opt for fair value through P&L. We opt for fair value through P&L. Either we are having a liability which is held for trading, very rare situation. Nobody holds a liability for trading. Or you want to avoid an accounting mismatch. Avoid an accounting mismatch. So for example, you took a loan to finance investment property. That investment property under IS 40 is kept under fair value through P&L. Yes, fair value model. So if you have taken loan for that and you want to avoid an accounting mismatch, you will go for this method of financial liability, right? Now, further they say, within this, there will be a fair value movement because of the credit risk of your liability. If you are liable to make a payment, credit risk means you will go bankrupt or you will have financial difficulty due to which you won't be able to repay. So fair value movement, which is due to credit risk, goes through OCI, and the fair value movement due to other factors, market factors, that goes through P&L. Right? So this is what is there in our IFRS 9 basic. So this is, I'm not doing that derivative and hedging. I'll place a link of derivatives and hedging in my description box. I've made a proper video on derivatives and hedging. If you're from IFRS, we've not done this in FR. We have actually done this in SBR. So that is a proper video on derivatives and hedging. So you can refer to that, right? Okay. Okay, guys, so let's continue with next topic that is related to IFRS 16 on leases. Once again, basic concepts involved in IFRS 16. Now here, basically, we talk about two people, two parties. One is your lessee, another is your lessor. Lessee and lessor. Now this lessee is basically that sweet looking person who takes the apartment on rent, the tenant, and the lessor is the landlord, the weird looking landlord, strict. So lessee is taking the apartment on rent and the lessor is giving the apartment on rent. And in IFRS 16, what we are given is both the types of accounting. At FR level, you just know the lessee accounting. But in SBR and diploma in IFRS, you need to know both types of levels. So here in lessee accounting, initially, I just discussed the lessee accounting. So we just have ROU, right of use asset, and lease liability being recorded, where my ROU is lease liability plus any payments made on or before the commencement of lease. And my lease liability is present value of all lease payments. So this present value of all lease payments, what is this? The lease payments comprise of fixed lease payment, fixed rent that you pay, variable rent that you pay, any option to extend that or any option to terminate the contract. All of these things, costs associated with them, are added to your lease payment and you calculate the present value of it. Now, this present value is calculated at rate which is implicit in the lease. Okay, we take the rate implicit in the lease, and if this is not available, then we go for incremental rate of borrowing. Incremental rate of borrowing, right? So this is what you do. Now, lease liability plus any payment made on or before the commencement of lease is ROU, and now you know what is a lease liability. So subsequently, what do you do with this ROU and lease liability? Subsequently, in the case of ROU, you simply depreciate the ROU. You depreciate the ROU at a lower of two things. whatever is lower, that is life of the asset or life of the lease term, right? Whatever is lower, based on that, you depreciate your ROU. And for the lease liability, you again make a table that is opening lease liability plus interest minus cash that you've already paid gives you closing lease liability, assuming that your interest was paid in arrears. So here, once again, this is known as unwinding of interest. So this interest is basically on the same interest rate that you used for the calculation of present value. So this is the lessee accounting. Now go over here, what next we have is sale and lease back. Now in this sale and lease back, I have totally skipped the lesser accounting, okay, as it is a fast track, not something which I'm delivering from the scratch, okay. So it's something that is fast track. So just basic concepts. In sale and lease back, what we do is we have to refer to IFRS 15 first of all, whether it is a sale or it is not a sale. So there are two situations where it is a sale and it is not a sale. So what will this sweet looking person lessee do in that case? And what will that weird looking person lesser do in that case? So the lessee is the seller because he sold the asset and then leased it back. And this lesser is the buyer. So what will they do if it is a sale? If it is a sale, then simply the seller is going to de-recognize the asset, quite obvious, de-recognize the asset. And it's a sale, so he will record a financial asset because he is supposed to receive money because he sold an asset. And then he will do his lessee accounting, where he will calculate his ROU, which is calculated as PV over FV. You need to retain this. PV, that is present value of lease payments divided by fair value into carrying amount. So PV over FV into CA. And you create a lease liability, which also gives you a profit or loss on disposal, right? So this is what you do when the transfer is a sale, and that's what you do in the books of seller. Now, what do you do in the lesser? Lesser will simply recognize the asset because he's the buyer also, and he will create a financial liability because he needs to make the payment. There will be a payable, and then he will do his normal lesser accounting, right? He will do his normal lesser accounting. Now, when it is not a sale, what do we do in that case if it is not a sale? If it is not a sale, we simply, what we are going to do, we will keep on recording the asset. So whatever money we receive, because legally it is a sale, but economically it doesn't meet the IFRS 15 control definition. So we simply say, okay, we will keep on recording the asset. Whatever money we receive is treated as a loan, and whatever rent you pay is treated as interest on loan. And then what do you do in the books of the buyer? The buyer will similarly, he will think that he has given a loan. So here you took a loan, the seller took the loan, and here the buyer is giving a loan. So he will create a financial asset. Whatever rent he receives will be treated as rent income, or you can say interest income, sorry, interest income. So this is what happens in case of sale and leaseback. Lastly, if this transfer is a sale, this is what I assume when transfer is at fair value. Now, what if my transfer is not at fair value? So if my transfer is above fair value, then I'm going to have a proper, balance which will be created because my bank will be now debited by more than fair value. So I will have a balance in the credit side. So when the transfer is above fair value, you receive more money. Then that extra money that you receive is treated as financial liability. And if the transfer is below fair value, that lower payment that you receive is treated as your prepayment. You assume you received it before prepayment, right? So this is what we do in case of sale and leaseback, and I hope it's clear. So that's the end of IFRS 16 basics. Now, guys, fast track revision. Let's now move to group accounts. Very important. So group accounts. First, I will do to the level of FR that you guys have already done, right? Then to the level of SBR and Diploma IFRS. So in group accounts, what we have is, we have to first of all know what is the definition of control. So what is the definition of control? Control arises when you have right over the variable returns. You have power over the investee. You have power over the investee. You have the right over the variable returns. That means either it's a profit or a loss, you have a right over it, and you have the ability to effect those returns. You also have that ability to effect those returns. So if these three conditions are met, then you have control. Now, since you have control, what happens next is, you'll have to consolidate. So if I control a company, I'm the parent, and that company which I control is my subsidiary. And I'm going to consolidate. I'm going to create consolidated statement of financial position and consolidated statement of P&L. Now, there are situations where you might have just 48%, 45% of shareholding, still you have control. So you should know those situations, right? So that's your homework. Write it down in the comment box. What are those situations? Then consolidated statement of balance sheet. How do I prepare it? I'm going to add up everything. As if I own everything. So I will add asset and liability of the parent at 100%. Then I am going to eliminate intra-group transaction. Right? And lastly, I am going to show up to the extent I don't own the subsidiary. That means I will show the minority or non-controlling interest. So that's what I do in my group balance sheet. This is how I prepare my group balance sheet based upon these three principles. So I have 5 working notes. We quickly discuss what are those 5 working notes. Working note number 1 is related to group structure, where you talk about, okay, what is the structure of the group? Who's the parent? Who's the subsidiary? In SBR and diploma, you have that situation of who is the acquirer, identify the acquirer. It's not always very simple that A acquired B. So usually the acquirer is the bigger company, the one who issued cash, the one who issued equity instruments, the one who has majority voting rights, the one who can appoint majority board of directors, all these things. So you identify the acquirer. There might be an associate. Associate, I hope everyone knows, it's significant influence, that is power to participate, right? And if you have significant influence, you follow the standard, that is IS 28. That is equity method of accounting. One line, single line accounting. Then you have working note number 2. Now this working note number 2 relates to fair value of net assets of the subsidiary. Fair value of net assets of the subsidiary. So IFRS 3 says you have to take fair value of the subsidiary's net assets. Net assets are the worth of the subsidiary. So what was the net asset of the subsidiary at acquisition date? And what were the net assets of the subsidiary at reporting date? That's what you take, right? So your net assets include share capital, share premium. Then related to the subsidiary, you have retained earnings, revaluation surplus. You might even have some fair value adjustments. And on those fair value adjustments, there might be some additional depreciation as well. So you consider what were all these things at acquisition date, what were all these things at reporting date. That the difference between this and this gives you post-acquisition movement. In this post-acquisition movement, the parent in working note number 5 and the NCI in working note number 4 will have a share. Then you have working note number 3. That is, working note number 3 is goodwill. Now, guys, there are 2 types of goodwill. One is full goodwill, another is proportionate goodwill. Full goodwill is when my NCI is taken at fair value. And if this goodwill is impaired in future, the impairment will be allocated to both NCI and parent based upon their proportion. What is proportionate goodwill? Where NCI is taken at a percentage. NCI is taken as a percentage of working note number 2. And if this proportionate goodwill in future has to be impaired, at FR level, you should just know that if it is impaired, it is just allocated to the parent, not to the NCI, because it is partial goodwill, no? So it just belongs to the parent, not to NCI. Now, from SBR perspective and diploma perspective, everyone knows that if we have proportionate goodwill and we want to calculate what is the impairment of that goodwill, we need to calculate TNG, that is total notional goodwill, right? So in this, you basically take what was your goodwill at that particular date. You apply unitary method and you get to know what was your total notional goodwill. Now, this total notional goodwill will be used to calculate the impairment, and then you will allocate the impairment and only the parent share will be recorded. So simple proportionate goodwill is partial goodwill where NCI is taken as a percentage of working note number 2. Simple. Next, how do you calculate goodwill? Your formula is proceeds, whatever proceeds were paid by the parent, and NCI. So NCI's value based upon if it is full goodwill, it will be at fair value. If it is partial goodwill, it will be as a percentage of working note number 2. Then in that, whatever you get, you deduct from this the working note number 2, that is fair value of net assets of the subsidiary at acquisition date. Then whatever you get is your goodwill at acquisition, which is then impaired. And then whatever you get is your goodwill at reporting date. So this is your goodwill at reporting date, right? Then comes your working note number 4. That is NCI. So simply whatever NCI was taken in working note number 3, based upon full and partial goodwill, in that we are going to add NCI share in post-acquisition profits, NCI share in post-acquisition profits. Then if there was full goodwill calculated, then what is NCI's percentage in goodwill impairment, right? So that is what we are going to show here in the working note number 4, giving us NCI at reporting date. Then lastly, we have working note number 5, which is based upon group retained earnings. So what were the parents' retained earnings? I'm going to take parents' retained earnings, whatever they were, 100%. In that, whatever was parent share in the post-acquisition movement of subsidiaries' retained earnings, I'm going to add or deduct that. Then if there was any PURP, intra-group transaction, PURP, if the parent is the seller, this PURP is deducted from here. If the subsidiary is the seller, PURP is deducted from working note number 2. So if subsidiary is the seller, PURP comes here. What is this PURP? If there is a transaction between parent and subsidiary, so parent sold goods to subsidiary at a profit, I need to remove that profit. So whatever goods are still there within this territory, on that, we call this as an unrealized profit. We calculate that, and then we, if the parent is the seller, that unrealized profit is deducted from your working note number 5. If your subsidiary is the seller, then that unrealized profit is deducted from working note number 2. Now, guys, this is our 5 working notes. If there was any deferred consideration on acquisition, so you must have calculated present value, sibling of present value, unwinding of interest. So that would also come here. Then parent share in goodwill impairment, that is also going to come in working note number 5. So working note number 5 can have many things based upon whatever question you are solving. So it's not something that I can say, okay, only this is there in this. There can be many things, right? So this is our basic group accounts, the balance sheet. What is there in group statement of profit and loss? The only thing that I want to revise with you is that in group statement of profit and loss, in the revenue, our group revenue, if there was an intra-group sale, that intra-group sale amount will be deducted from the revenue. If there was a purchase, if there was a sale, there must have been purchase also. For one parent sold goods to the subsidiary. For the parent, it's a sale. For subsidiary, it's a purchase. So I'm going to remove intra-group sale from there as well. So basically, I'm going to remove this from COGS. Purchases are reported in COGS. And I'm going to add QRP to the COGS. Why? Because if I need to remove a profit from my P&L, I need to increase my cost, right? So this is what I do in my group statement of profit and loss. So these are the basics done from the, you can say FR perspective that you guys have already done in F3, FR, even in your CA and in CA, you must have done this. Now comes a little elevated perspective, which we do in SBR and in diploma is also there. That is related to our change in group structure. Change in group structure. So here what we do is there are various steps. This is the golden door of control. If I pass this control door, I will get more than 50% shares, right? So once I pass this door, I will get control. So I will consolidate. I will consolidate. If I do not pass this door, I am still here from 0 to 20%. It is known as associate. It's known as associate. From 20 to 50%, it is known as 20 to 50%. It is known as your, sorry, 0 to 20% is your normal IFRS 9. 0 to 20% is your normal investment, IFRS 9, which you keep under equity instrument, financial asset. And this is IFRS 9. And from 20 to 50%, it is IS 28, associate, significant influence. After this, it is parent subsidiary. That's a control situation. So you might move above this in bits and pieces. You might move up the stairs in bits and pieces. Maybe you acquired first 20%, 30%, then you acquired more 20%. So it's not that suddenly you acquired 80%. Or you might dispose the shares also in bits and pieces. Now, this whole thing is known as step acquisition and step disposal. Step acquisition and step disposal. So in step acquisition, guys, we have two situations when we move from control to control. You already had 60%, you acquired 10% more, now you have 70%. Next is when you move from no control to control. You just had 30%, now you have 60%. So in this case, your NCI decreases, more shares you acquire, you decrease the NCI. So you would normally pass a journal entry because you're selling, because you're buying the 10%. So money is going out. So bank is credited. Your NCI is decreasing. Whatever is your balancing figure that goes to other components of equity. Now this decrease in NCI is not given in the question. You need to calculate it. So you use unitary method to calculate this decrease in NCI, right? Then what about this? When I move from no control to control, what do I do in case of no control to control? I will first take that 30% which I already have previously held interest. I will take that to its fair value. Whatever will be the movement that will go through statement of profit and loss. Then I will calculate goodwill on acquisition. Since you are acquiring more shares, which is giving you control, you will calculate goodwill. How do you calculate this goodwill? You say proceeds that you paid to acquire the extra shares plus fair value of previously held interest, fair value of previously held interest. From this, see, you're going to add your NCI based upon whether it's full goodwill or proportionate goodwill. From this, you will deduct that working note number 2 that will give you fair value of net assets of subsidiary that will give you goodwill on acquisition date. So this is what you do when you move towards no control to control. Then let's talk about step disposal. In step disposal, guys, again, we have two situations. Situation number 1, when I move from control to control, that is same as step acquisition. You previously had 70%, you dispose something, now you have 60%. So you calculate what's your increase in it using unitary method. Again, you use that journal and the balance figure goes to CE. In step disposal, what do you do? Another situation is when you move from control to no control. Everything is finished. Hindi we say khatam, tata, bye bye. Everything is finished. So control you had 80% and now you just have 10%. So now you need to calculate the gain or loss on disposal. It's very necessary. So how I'm going to calculate this gain or loss on disposal? What will be my formula to do so? Please look at the formula. I'll say I've sold something, so I must have received money. So what are my proceeds to receive money? Whatever money that I've received, I'm happy about this, so I'm going to add it. Now the subsidiary is going, that NCI is a headache. So the NCI is going, so I'm going to be happy about it. So add NCI. Now that subsidiary that you're selling off, you already had this, you still have this 10%. So what is the fair value of retained interest? You're still happy with it? You're still talking even after the breakup, so you're happy about that maybe? Fair value of retained interest, we are going to Add this. Yes. So this is going to give me total things which I'm happy about. Now, what all I'm sad about? Subsidiary is going out. So the goodwill is going out. I'm sad about that goodwill, right? And the subsidy, this is all at disposal date. Okay. NCI at disposal date, goodwill at disposal date. Then I'm sad about I'm sad about the net assets of the subsidiary. So I'm going to deduct that at disposal date. So this is my formula. This is my formula for in total group profit or loss on disposal. So this is what you do in change in group structure. Simple. Next, extra aspect from the perspective of diploma IFRS, which you guys have already done in SPR, that is related to your foreign exchange. So in this foreign exchange, guys, you simply say in individual accounts, that is IS 21, I have a rule. And that rule says that I need to first bifurcate if I have monetary items in my balance sheet, which relates to foreign currency, or if I have non-monetary items in my balance sheet, which relates to foreign currency. So if it is monetary item, readily convertible into cash, I will convert this at the reporting date at closing rate, which will give me a gain or loss, which will go through statement of P&L known as exchange gain or loss, individual accounts. Non-monetary items like PP in individual accounts, if they relate to foreign country, you'll simply keep them at historical rate. If you keep something at historical rate, there will be no gain or loss. Now come to groups. What if you have a foreign subsidiary? What if you have a foreign subsidiary? So first you should determine what is the functional currency of this foreign subsidiary. So functional currency is the currency of primary economic environment. So you will first determine the functional currency of the subsidiary. You have proper rules to it. Like how do we determine it? There are factors. Then after determining the functional currency, if the parent's functional currency is equal to subsidiary's functional currency, then simple IS 21 rules will apply, which we just wrote above. That monetary, non-monetary, monetary taken at closing rate, non-monetary at historic rate, and whatever is the gain or loss that goes through P&L exchange difference. But if the parent's functional currency is not same as subsidiary's functional currency, so functional currency of subsidiary is, let's suppose, pounds, and parent's functional currency is dollars. So what we are going to do in that case? We are going to retranslate, not even convert. We are going to retranslate the results of subsidiary, which are in pounds, to dollars at the reporting date. Now, what are the rules attached to it? The rules say that all the assets and liabilities of the subsidiary will be retranslated using the closing rate, and all the income and expenses will be retranslated using our average rate, right? And then whatever will be my difference, because obviously if you let's suppose you're taking net assets at closing rate, closing net assets at closing rate, and the movement, the profit you're taking at average rate, so there will be a balancing figure. That balancing figure is known as your retranslation reserve. Okay, and this retranslation reserve goes via OCI, and then in future it might be reclassified to P&L when you sell your subsidiary. So that's the rule for group foreign currency. That's it. Then you have group statement of cash flow also. Group statement of cash flow. Till now, we've prepared cash flow for individual companies only. We have never prepared it for group statements of cash flow. So here simply we have normal bifurcation between operating activities, then we have our investing activity, then we have our financing activity, same as individual cash flow. The only difference in group cash flow and individual cash flow is that when you buy a subsidiary, you record that purchase. That's an outflow. When you buy a subsidiary, you pay money in the investing activity. you need to record it at net amount, because if you are paying something to buy a subsidiary, you're also receiving subsidiary's bank balance, no? Subsidiary's cash balance. So you record that outflow at net, right? Then if you sell a subsidiary, then you are going to receive money. So there will be an inflow. So once again, you are going to record that inflow at net amount. And then if you want to calculate what were the dividend paid to NCI or dividend received from associate, you need to make a T-shaped account of NCI and you need to make a T-shaped account of associate to calculate whatever was the dividend paid or received from them. Right? And working capital movement. In operating activities, you also have working capital movement. So in that working capital movement, you are simply going to say that, let's take an example of inventory. So in the opening inventory, I have some balance. In the opening inventory, I have some balance. Okay, whatever is the balance, XXX, right? And I will say there is closing inventory. Now, closing minus opening is the movement, and that movement goes to cash flow. If that inventory increases, we say it's an outflow because you bought an asset. If the inventory decreases, we say we sold an asset, so that's an inflow. Now here, guys, if you have acquired a subsidiary during the year or you have disposed a subsidiary during the year, the results of that acquired subsidiary are there in the closing balance but not there in the opening. So they are not like for like. So what we do, if we have acquired a subsidiary, we add the results to opening balance during the year. If we have disposed a subsidiary, we deduct that from here and we get an adjusted opening balance. We get an adjusted opening balance. Now we compare this adjusted opening balance with the closing balance. And now we calculate whatever is the movement that will go into cash flow, outflow or inflow. So this is about group statement of cash flows, right? Okay. So basically we are done with the important concepts of diploma in IFRS, but there are two standards which are something you've not done in FR at all. So usually we've not heard about these two standards. That is your share-based payment, IFRS 2, and IS 19 employee benefits. So I'll quickly cover these two and then we'll wrap up. So IFRS 2, guys, share-based payment. There are two types of share-based payments. One is your equity settled share-based payment. So when you give share options to your employees, that is equity settled share-based payment as part of your package. Cash settled share-based payment is when you give share appreciation right. So the employees are going to get money, they are going to get cash based upon how much the value of the SAR has changed. So in case of equity settled share-based payment, my journal entry is expense debit and my equity credit. In case of my cash settled share-based payment, my journal entry is expense debit and my liability credit, right? Now, guys, what are the rules? In equity settled share-based payment, you calculate your expense and equity as number of employees who are going to get share options. Number of employees who are going to get share options. How do you get to know how many number of employees will get the share options? It depends upon the conditions. Now, there are two types of conditions. One is market condition. Another is performance condition or non-market condition. And we just take into account the non-market condition by calculating the number of employees. Because market conditions are not in hand of the employees. So market conditions are already adjusted in the fair value of the share option at grant date. So number of employees who are going to get the share options into number of share options they are going to get into fair value of that share option at the grant date. If the vesting period is 3 years and this is the first year, then 1/3. Because we recognize the expense over the period of time. So if the conditions will be met in 3 years and this is the first year out of those 3 years, so you will say it is 1/3. 1/3 will be recognized, right? And the only difference in cash settled is similarly here also you calculate number of employees who are going to get the SAR, number of employees based upon conditions. into how many share appreciation rights each employee has. But here you take fair value of the SAR at each reporting date. Here it was at grant date. I take it at once only. Here I will take a different fair value at each reporting date. And once again, this will be also 1/3 if the vesting period is 3 years and first year is going on. And extra one thing for cash settled share based payment is that whenever you pay cash to the employees when they exercise their SAR, you always pay it at intrinsic value. Intrinsic value, okay? And you need to take note of this, that cash is always paid at intrinsic value. So these are the mere concepts that I'm delivering, okay? I am supposing you guys have already done this. This is a revision. So it is intrinsic value that we take into account. Then we're done with IFRS 2. We have already been removed from our syllabus, modification and cancellation part. Then you have IS 19, employee benefits. What is there in the employee benefit? Simple, there are two jars. One is the planned asset pension obligation jar. Obligation, I'm talking about defined pension scheme, defined benefit scheme, pension obligation, and another jar is planned asset. So every employer gives some kind of benefit to the employee. They tell them that we are going to deduct some part of your salary and that will be invested in a provident fund. When you retire, you'll get a pension. Now, if you define that pension, how much pension this person is going to get, then we call this as defined benefit. We call this as defined benefit. So how do you treat this defined benefit scheme? There is one format to it and you're done with the chapter. And that one format says that you first calculate the fair value of planned asset and present value of pension obligation. That gives you opening net deficit or surplus. So let's take a situation of net deficit where my obligation is greater than the liability. Net deficit. In this, I am going to, if there will be any contributions, if you make any contributions to the plan, this is your net deficit. If you're going to make any contributions to the plan, that means you're going to add, the employer is going to add something to the provident fund, to the investment, to the planned asset. So that is going to reduce your deficit because it will increase your asset. So that will reduce your deficit. Then if there will be any service cost is basically current service cost or past service cost. That is a change in your pension liability because of current reasons or past reasons. So this is going to increase your liability. If your pension liability increases, your journal is P&L debit, liability credit. And under the P&L, it is taken via the heading of service cost. So this is going to be added to my deficit. Right? Then net interest component. So on the planned asset also you earn some kind of return, and on the pension obligation also you pay some kind of interest. Not pay actually, but you just unwind the interest because that pension obligation is being stated at fair present value. So you need to unwind the interest. So net interest will be added here because here, of course, if my obligation is greater than my asset, if my obligation is greater than my asset, then obviously I am paying more interest than I am receiving. Right. Then if there are any benefits paid out during the year, if you have paid out some benefits to your employees, so that has nil effect. Nil effect in the P&L, nil effect in the balance sheet, nil effect in the cash flow. Why? You take out money from your asset jar and you pay off your liability. So there's no effect on it. That is nil effect. And that will give you a closing balance according to you. But then this person will come in dancing in your life and this person is known as actuary. Right? And this actuary will give you a closing deficit, which will be different from what you calculated. So difference between this and this is known as remeasurement component. And this remeasurement component then goes via other comprehensive income. That's it. So this is the basics of IS 19. There are many other things involved also. So I hope you know that plan, amendment, settlement, curtailment. So if there is any amendment, settlement, curtailment into your pension plan, that must happen via service cost, number one. Secondly, after the date of PASC, that is amendment, settlement, curtailment, you should use updated assumptions to calculate your interest and to calculate your service cost. That's it. So this is the end of our IAS 19 as well. So there are a few other small standards like IS 37, IS 10, IS 2. There's agriculture, inventory, all these small standards which I can trust you guys to do it. So this fast track revision that I've done is basically a revision. Okay, it's not something which you can only rely upon. So if you were helped via this, because I touched upon each standard and each heading of that standard, so now you exactly know what is the content of it. Yeah, deferred taxation IS 12. I will place the link in the description box. There's a proper lecture on it, on IS 12 and derivatives and hedging. We have proper lecture. You can go through that. So this is the end of our fast track revision, guys. I hope it was helpful. So if you are preparing for your exam, please keep smiling. I'm sure you will pass. And if you plan on to enroll with me, I've given you the details in the beginning of the class. You can message me on my Instagram, on my LinkedIn, or on my WhatsApp number, which is provided in the description box. So thanks for watching it till here. May God bless you all, sending all the good vibes and wishes. May you all pass with flying colors and be part of my free global WhatsApp groups for time to time revisions via voice note. So take care, guys. Goodbye and have a nice exam. All the best.